How to deal with cash flow problems in small business. Your cash flow problem is not really a math error, it's really more of a money behavior problem that you don't even know you have. I'm going to show you that you can learn how one popcorn bucket tweak can solve a lot of your cash flow issues. By the end of this video, you're going to have a 3-step process to end cash flow stress and also stabilize that bank account. Now, when we talk about cash flow, we really got to identify what in the world are we talking about, because you could go into your accounting software and pull up a cash flow statement, and the moment you print that statement, it's basically outdated. We look at money in 3 phases: past, present, and future. And basically anything that goes into a report, we kind of put in past: balance sheets, profit and loss statements, things like that. Now, some of you might be listening to this and going, I've heard of those phrases before, but I really kind of feel a little bit overwhelmed on that. Don't worry about that right now. Really, all I want you to focus on is that money, we look at it in 3 phases: past, present, future. And anything we can put in a report is usually going in the past. So then the question becomes, how do we look at money in the present and how do we look at money in the future? And so we're going to talk about that. First thing I want to do is tell you a story about a home building company. It was actually a really successful home building company, about $15–20 million annual revenue. And they came to us. We tend to work with a lot of contractors and business owners in that space. And they said, hey, we've got cash flow problems that we need to solve, but we really don't know how to do it. We got a lot of cash coming, but we also have a lot of cash going. So they realized they had cash flow, but the cash flow was a problem. And so the more we got to digging, we ended up finding out that once we got to our strategies and built those out, which I'm going to walk you through, they asked us a second question. And this was the question that really threw us off. And it was this: hey, what do we do with unfunded client deposits? I was like, I've been doing this a long time and I've never heard that phrase before. And so I queried, what is an unfunded client deposit? And they said, well, we take client deposits on the start of projects, but we'll take 10% and maybe use that for somewhere else. Rob Peter to pay Paul. And I said, I got it. I said, that rob Peter to pay Paul is a phrase that contractors use to not feel guilty about the reality of what's happening, what the IRS calls stealing. And so when we take client deposits and use it for non-client things, even in the business, that is not a healthy way. In fact, the IRS looks upon that and frowns upon that pretty significantly. And I said, by the way, to the tune of what amount are we talking about? And they said, well, we've got somewhere around $1.7, $1.8 million outstanding of client deposits that we've received, and now we're using for something else. Whoa. I don't want you to be in that situation. And in fact, it took us about 1.5 years to climb them out of that situation. Client deposits need to be used for client deposits, and other streams of income need to be used for what they need to be used for, but how do we know the difference? So I don't want you to be in that situation. I don't want people like us coming to you and going, hey, I need unfunded client deposits. We're like, what is that? No. We need to think about money completely different. So before we dive into the 3-part strategy, I want to identify that money has a behavior. It's kind of got its own soul, which is really kind of creepy if you think about it, which is why we also need to be in the habit of cutting money out of our lives to some degree, because if not, it'll control our heart, kind of become an idol for us. And so there's so much history around that to see what that looks like. In fact, if you're a student of Jesus at all, it's the #1 topic he talked about more than anything else. You would think that's a little bit odd that here comes this spiritual religious leader and he talks a lot about money and the dangers of money. And so as we look at that, I want you to understand money has a behavior, and it goes like this. You ready? A dollar is not a dollar. In fact, I could even encourage you, this is great kitchen table talk with your kids. A dollar is not a dollar. So what do I mean by that? All right, let's go on this side of it. A dollar out is always going to be more. What does that mean? That means when you go buy a sandwich for lunch and the menu board says the sandwich is $9.95, are you going to pay $9.95 for that sandwich? No. You're going to pay $9.95, plus you're going to pay tax, plus you're going to pay whatever that fee is when they turn the screen around and they go, hey, this screen's going to ask you some questions. And really all they mean is just give me a tip for turning the screen around, right? So you're going to pay $9.95 plus in a lot of scenarios. So a dollar out is always more than a dollar. But the flip side of that is also true. A dollar in is always less than a dollar. What do I mean by that? All right, you get a receivable in your business for $100 or $1 million or whatever that receivable number is that comes in, you're going to put in your bank. Do you get to keep that $1 million or $100 or $1,000? No. You got cost of goods, you've got expenses, you've got overhead, you've got a variety of different things that you've got to pay out of that. So a dollar in is always less. A dollar out is always more. A dollar is not a dollar. So let's figure out how to deal with these cash flow problems in a small business. I'm gonna walk you through 3 steps. Number 1 is, remember I said money comes in past, present, future? How do we look at money in the present? It's whatever money is in your cash bank accounts. Now, this brings up an issue of accrual and cash accounting, and I'll get to that here in just a minute. But let's just go and look at cash bank accounts real quick. So when we're thinking through cash bank accounts, the cash that you have in the accounts is the decisions that you can make on the business based on the cash that's actually in the accounts today. If you don't have the cash, then you're going to make different decisions. If you do have the cash and you know where it's going to be pars or where it's going, then we can make different decisions. So when we look at subdividing cash, and we'll look at it this way. Take $1. So imagine you've got $1. We're literally going to just start to cut that dollar up. So when that dollar comes into your business, and let's say you've got a 30% cost of goods, you've got to pay other people to do things because you sold this particular job. So we're going to take 30% of that dollar and we're going to put it in its own bank account. And then let's say your overhead is 25%. I'm just making these numbers up. We're going to take 25% of that same dollar and we're going to put it into an operating expense account. Let's say your tax liability on any given year, according to your top line revenue, is somewhere around 5% or 8% or whatever. You're like, wait, I thought it was like 30%. No, the total revenue, where you're only taxed on your net income. So let's say that it's 5 or 8% of your total revenue. We're going to put that in its own bank account. So we're going to have 6, 7, 8, or 9 of these bank accounts that we cut that dollar up and start to put them in their own home. You ever heard of Dave Ramsey? And he's got those envelope systems. All this is the envelope system for business, but we're using bank accounts instead. So we're looking at money in the present right now. So what does that tell us when we can look at all these individual cash accounts? It's got cash in the accounts. Well, if I've got this much in the operating expense account, if that expense account runs out, then the business is now talking to me. I understand that my cash flow is moving, but I can actually see the flow of cash rather than it being on a report that I pull from an accounting software. So step number 1 is, for every dollar that comes in, we're going to cut that dollar up and put it in its own bank account home. And you're going to start with about 6 or 7 different bank accounts. I want to give you a metaphor that I think will be helpful with the subdivided bank accounts. I love movie theater popcorn, like love it, way too much. I get sick when I eat movie theater popcorn because I eat so much of it. Why? It's because when I go there, I buy the big bucket. And it's the bucket size where you can go get refills on it. You know what I'm talking about? So you can pour all this butter on it and just eat it and enjoy it, and then you feel sick at the end. But when I get that big bucket of popcorn, do you know how much of it I eat? All of it. I want you to think about that big bucket like one bank account. If you're running your business from 1, 2, or 3 bank accounts, it's akin to you buying the big bucket of popcorn. All the popcorn's in the bucket, but you have no idea if some of that popcorn's for you as profit, for the government as tax, for your operating expenses, for your cost of goods, nothing. It's just all in the big bucket. And not only that, but if some of the popcorn falls out of that bucket, you just kind of leave it on the ground because you got a lot more popcorn in the bucket, right? So we just sort of let that go. But if I took that same bucket of popcorn and I had 8 smaller buckets, and I took some of the popcorn from the big bucket, poured it in the smaller bucket, distributed it, now I've got 8 individual buckets. If popcorn falls out of one of those smaller little buckets, I'm picking it up because there's only a limited amount of popcorn there. And if that popcorn goes out of that smaller bucket, then I see that I don't have enough popcorn in that bucket to fuel what I want to be able to eat. And if I ate all 8 of those buckets of popcorn, you'd make fun of me, right? And so we've got eagle eyes on those popcorn when we subdivide everything out. So I want you to think your bank accounts like that big bucket of popcorn. If you're operating your entire business from 1, 2, or 3 bank accounts, you're a big bucket. But if we've got these subdivided 6, 7, or 8, now we've taken that big bucket and we've started to distribute it. The second thing that you can do to solve your cash flow problems is, once we have our cash cut up into those different buckets so we can see how much we have in the different areas of the business, then we're going to start to track what we call our ABCs. That's our accounts, our bookkeeping, and our customers. Because if we don't have customers, then we don't have revenue. If we don't have bookkeeping, then we don't understand expenses, what's coming in and what's going out. And if we don't understand our cash accounts, or the A of the ABCs, then we don't know how much we have to actually work with, how much fuel's in the tank. So your accounts are going to tell you how much gas is in the tank, your bookkeeping is going to tell you what's coming and what's going, and your customers are going to tell you what the pipeline looks like moving forward. Now, don't be overwhelmed by this, because I know what you're thinking is, I need to go buy an expensive piece of software. No. Start with a spreadsheet. Literally do one sheet that's accounts, one sheet that's bookkeeping, meaning receivables and payables, and one sheet that is customers. And whatever you track for customer metrics, it could be people we called, leads that came in, website hits, I don't care what it is. Whatever you want to track to help give you an understanding of what the pipeline looks like, then start to track that. You can just track it on a spreadsheet. Here's what I want you to do. I want you to do it once a week. the same day every week. It could be Monday every week, Tuesday every week, Friday every week, it doesn't matter. But I want you to track it week by week. And over the course of the year, you're going to start tracking your cash accounts balances, the A. You're going to start tracking your receivables and payables each week, the B. And you're going to start tracking your customer metrics each week, that's the C. All right, the third thing I want you to do is super, super simple, and it's the communication around that. If we don't have proper communication, then we're just going to kind of make things up. In fact, there's a statement, I don't remember who made this, but it says in the absence of communication, the mind makes things up. And we don't want to do that. We want to have repetitive, predictable, meaningful communication. Did you see what I did there? The RPMs of great leadership: repetition, predictability, and meaning. How do we do that? If you can set a once weekly, 1 hour, agenda-driven, leader-led meeting just around the ABCs, that tracking dashboard, you may not even need an hour. You might need 15 minutes, 30 minutes. But to have one point of contact where you're coming together, where you're looking at those subdivided bank accounts, that's point number one. You're looking at the accounts, bookkeeping, and customer tracking on a spreadsheet. That's point number two. And now point number three, we're having this meeting together. So what we've got is repetition, predictability, and meaning around the subdivided cash in the business. And then we're tracking that every single week so that we can watch the flow of cash. So instead of thinking cash flow, I want you to think the actual flow of cash. Why? It's because cash flow now occupies a space in our mind that's cliche. So when we hear it, we just think of a report we pull from a bookkeeping software. But when we think about the actual flow of cash coming in, going out, which also brings up one other note. Some of you are like, well, we do accrual. And others are like, well, we do cash accounting. What's the difference? I want you to look at it like this. Accrual accounting is basically people calling into an RSVP. And they go, yeah, I'm coming to your party. I'm coming to your party. I'm coming to your party. And so that thing builds up and builds up and builds up. And so you get your hopes up that you got 50 guests coming to the party or 80 guests coming to the party. But cash accounting is who actually shows up at the party. So if you only have 8, then that gives you a reality of who's actually at the party. You don't have 50 at the party because the RSVP says it. You have 50 at the party because 50 show up to the party. That's why we prefer in day-to-day for business owners for you to live your life in cash accounting. Let your CPAs and let the IRS deal with accrual accounting, which, by the way, is why we call it a cruel accounting. Just a little joke for you. Fun little accounting joke. All right, maybe even a dad joke. I've got a free gift that I think is going to be really, really powerful for you. If you go to solvecashflow.com, our team has prepared a cash flow handbook that will help you solve this problem for your business so that you can see your cash more as a flow of cash rather than just static cash flow looking in the rearview mirror. We can look in the present and we can look in the future. Go to solvecashflow.com. My name is Scott Beebe. We work with business owners 3 to 100 employees so that you can be liberated from chaos to make time for what matters most.